Hello and welcome back to The Note. We've heard from Janet Yellen today. She gave a speech in New York. It had an immediate impact. It moved the S&P 500 back up to a new record for this year. Let me try to put this in some context for you. First of all, if we take a look at this chart, you can see that Treasury yields dropped significantly, and that was perhaps the centerpiece of Janet Yellen's speech. She wanted to talk about the Fed's data dependency, its tendency to move in response to financial markets and to economic data, as being an automatic stabilizer. In other words, as things turned nasty earlier this year, you saw market traders automatically assume that the Fed would be more dovish, would lay off interest rate rises, and so you saw long-term interest rates fall, and that helped markets through. On that basis, which is a very elegant defense of the way the Fed has been behaving, given that data dependency tends to be very unpopular with many people on the markets. It tends to create more short-term volatility. That also implies, quite intriguingly, that we don't need to worry about the phenomenon of good news being bad news when we start getting economic data at the end of this week, particularly on unemployment data. If you do get a very strong unemployment number, the argument will be that that shows that the Fed's dovish talk, which talked down long-term rates, had been successful. It won't be taken as a sign that the Fed should have been more aggressive. Now, if we take a look at this next chart, there was another very intriguing part of the testimony, the speech, was Janet Yellen's saying that the neutral rate for the US economy in real terms may now be as low as 0, but that on her own measure of what real rates should be, that's comparing the Fed funds rate with the PCE core inflation rate, which excludes fuel and food, then as you can see, rates are still significantly negative and have been for a while. What she's arguing is that the rates will still never rise very much, but that they will still need to rise a few times before this cycle is over. That leaves her with some room for maneuver. Now, one more questionable assertion she made was that the very sharp sell-off we saw at the beginning of this year has left the international situation looking more worrying than it was when the Fed actually raised rates back on December the 15th. That you could question. If we take a look at this chart, all of these numbers are rebased to the Fed's December meeting. What we're looking at here is some of the key measures of pressure on the emerging world, which plainly was, with good reason, a big reason behind the concerns. And you can see that they're all actually up compared to December the 15th. That's crude oil, that's emerging market foreign exchange, emerging market stocks, and metals prices, all somewhat stronger than they were in December. All a sign that the Fed's dovishness has helped relieve the conditions. The fact that she is still talking as worriedly as she is about the international situation shows that she is concerned, and also that she is trying her hardest still to sound dovish. One final point to note is that she made it very clear that she didn't want to err on the side of going of hiking too soon, because the Fed's reaction would be asymmetric, that it could catch up if inflation began to rise by raising rates far more easily than it could correct an error if it raised rates too soon and saw deflation or stagnation coming in its wake. Now, where does that leave us? It leaves us with the S&P back at its highest for the year, still below its peak from last year, however. It also means that this next wave of data on Friday may be very slightly less sensitive than it was going to be. I would argue that for the longer term health of the market, we have earnings season coming up very soon as well. That earnings season will involve an extremely low bar of expectations, because forecasts have been written down very aggressively. If, with all this help from the Fed and with such a low bar to meet, that earnings season can't bring the S&P 500 above its record from last May, I would regard that as really quite concerning.